pet shop-like kind of environment. And when I was growing up, I saw the kind of difficulties you had if you are a merchant, right? And one of the things that stuck in my mind is that when sales are bad and you don't generate enough sales to pay the rent, my parents would fight, right? So this is a very common occurrence for other kids whose parents run businesses, right? Sometimes money is tight. Sometimes when times are good, obviously your parents will be more generous, but there are various ups and downs. So I grew up with this certain fear, right, about owing people like rental, right? Because the rent is fixed, but your revenue is variable, right? Now, as a consequence of that, right, obviously, my dad, being a business owner, he doesn't want the son to become a businessman as well, right? So eventually, I became a working professional. Uh, of course, that isn't just the only thing that shaped my mindset towards money. When I was just started work, I realized that very early that you can't trust financial advisors. And when before I got into national service, my mom got for me some kind of a policy that was supposed to where payments are supposed to stop when I start work. So she struggled for many years to support this insurance policy. But when I started work, right, and I took over, the policy kept asking us for more money every year. So we didn't know what we needed to do to solve that problem. So I brought my mom to the insurance company to lodge a complaint. And they were very smart. They are aware that the product is not performing based on what was promised. But they only left me with two choices, right? Um, Either I stop paying for the policy and I let it lapse. You take a number of years to lapse, all right? Or I carry on paying for an unknown period of time, right? And that kind of arrangement left a very bad taste in my mouth. Those days I was basically a entry-level engineer. I didn't know what my rights were, right? So it took me many years later, after I became a lawyer, to realize that I could have started a dispute resolution and made life difficult for them, right? But nevertheless, in my 20s, um, I had a really bad impression of the industry because I was burned very early. And you could say that everything that I've done subsequently, I did it without knowing a single financial advisor. Because to tell the truth, if anybody would call me up and ask me to go to McDonald's and catch up with me, my first question would be, are you a insurance agent or financial advisor? If the answer is yes, I would just say that I'll hang up. Right? I don't care how old your friend you are. I will unfriend you. Right? Yeah. And I think one of the bigger problems, right, is that our schools in our spring season, they don't really put in a lot of effort to teach you about personal finance, right? You're taught to be an obedient employee, and nobody would sit down with you and say that, if you apply this compound interest formula, you can become a millionaire in a certain number of years. So nobody really understands how money works, right? And more importantly, nobody tells you that when someone sells a product to you, there are a lot of these hidden fees and management fees, and you need to drill to understand how much of your money is lost to friction, right? When you buy, for example, an investment product. So that is something which is not taught, right? It's affected an entire generation of Singaporeans, right? In my generation. And you come off knowing that now, right, given the age of disruption, that if you study hard, there's no guarantee of good employment, right? And so the question you want to ask yourself is, what can distinguish you from other people, right? And gurus like Robert Kiyosaki might say, what's missing is personal finance skills, right? But the generation of finance books that we grew up on, you read books like Robert Kiyosaki, you come off getting very motivated about investing, and then you realize that something is very wrong. I listen to this guy talk on and on, but he doesn't really teach me how to invest my money, right? And it's only upon reading his fourth or the fifth book that I realized that it's It's all about multi-level marketing, right? He wrote this book called The Business of the 21st Century, which is to eventually make you more susceptible to these MLM people that will come into your lives, invite you for all these talks, and you end up spending thousands of dollars on these nutritional products that nobody wants to buy, right? And you're stuck. And so the story in my generation is that most of us get burned, by these MLM programs, right? Now, the idea about a financial education gets even more complicated. If you look at the kind of models that are being taught, informal finance trading kind of settings, right? What I have here is the discounted cash flow formula. And in order to calculate the asset of a product, and you attend the CFA and you attend some business school class, you need to do two impossible things. The first thing you need to do is that you need to project the cash flow of an asset into the future, right? That's already very hard, right? If you're the CEO of SIA, can you project a pandemic, right? Can you project a massive recovery, right? Can you even predict that Taylor Swift would add 6 days into the number of concerts that she's going to do? Can you predict that a Taylor Swift concert can cost thousands of dollars, right? Something like that, right? The next thing you need to do is you need to discount it to the present using an interest rate. That's also very hard because you have to project interest rates into the future. And even right now, we don't even know what the interest rate is going to be in Singapore next year because we don't know whether the Fed is going to continue to raise or lower interest rates. So as a consequence of that, right, when you have 5 different financial analysts telling everybody what is the value of a stock, you won't be able to figure out or have a consensus on how much is the value of a stock, right? And that's why when you look at a brokerage report, you find that the target price of your stock, it's not set in stone, right? It's not set in stone. So I think that's the problem, right? The myth is that, you study finance, it automatically makes you a great investor. And that's certainly not true. Okay. So to conclude the section in spring, there are 2 books which I think if you listen to me for this workshop, to get a decent financial education, you can read The Richest Man in Babylon by George Clason. If you want something more substantial on investing, which is the basics, right? The Conceptual Foundations of Investing by the Cornells, both books can be found in Kinokuniya, all right? So yeah, I don't get any commissions for them for recommending this to you, all right? So some of the questions that you think about when you're thinking about spring is, should I study something out of passion or should I study something that will get me a job, right? How long do I need to settle down on a career path? How do I navigate this world of personal finance? If my children are going through spring, how much support do I give them? Can I afford to further my studies? All right. So these are all valid questions for the first stage of your life. All right. And that concludes our discussion spring. The second section is going to be slightly longer. I'm talking about summer, and most of the listeners here are going through summer, autumn. And summer is the stage in your life where you spend most of your time making money, right? You also start a family at this stage. So for me, I worked in IT outsourcing. In the year 2005, the government of Singapore signed a comprehensive economic cooperative agreement with India. And that was around the time I was building up my career, and I realized that things are getting very hard, right? You've got highly trained professionals coming from South Asia into Singapore. They're very competent. They're also very cheap. As a consequence of that, it's not easy to get a decent increment if you're an IT professional in Singapore. So I was telling myself, either somebody's going to come and end my career, right, by getting my job outsourced. And eventually I was outsourced, right, from one company to another. I need to make sure that nobody digs my grave, right? So I decided to dig somebody's grave. So life is a little bit like Squid Game, right? If you're in the business of IT, I decided not to become one of the players. I decided to become one of the guys in the magenta or pink suits that you see on the screen here. I would take the SOP of an IT team. I would document it. Then I would train the team in Kuala Lumpur, and the people in Singapore will be redeployed. Some of them will be retrenched, right? Then I will rinse and repeat. I take the SOP, I go to India. And then after that, I'll get the call centers from Kuala Lumpur removed, because no matter what happens, the call centers in India is cheaper than the ones in Kuala Lumpur, right? So I was doing that, and life was good, right? I was doing that, and I was getting very strong rewards because of Joe arbitrage. We're reducing the cost for all the companies involved, right? So the people in IT, I think you know what I'm talking about, right? It's a brutal business. Now everything was fine and good until one day, when I was in Bangalore, and I received an email from Europe, and the email said that one of my colleagues, he's a contractor, his contract was not renewed. 2 weeks later, right, he committed suicide. He locked himself inside a room, and they got a device. They sucked all the oxygen out of the room, and he died, right? So that was when I realized that this is not a joke. When you do the business of outsourcing, in Europe, the work is moved into a place like Bratislava or Eastern Europe, right? Similarly to Asia, people are killing themselves when they lose their jobs, right? Yeah, so although this didn't happen in Asia and I wasn't the one that moved his job away, I became very guilty of being part of the project teams that did most of the outsourcing. So I decided that even while I was an IT professional, I want to do everything I can within my power, right, to sort of sort out this problem of IT outsourcing, right? And now I think technology, people are getting retrenched left, right, and center, right? So you're seeing history repeat itself, but in a different way, right? So in order to do that, I put in a lot of time to study the CFA program. This was basically evening class at the master's level. And you have to go through these books. I spend a lot of time doing this in the data centers when my servers are doing their backups. And I didn't learn a lot, right? I learned a lot of models, but I didn't know how to apply them in the stock market. And that went on until I realized that I read this paper by Robert Arnott and Clifford Asness, all right? And the paper says, surprise, higher dividends equals to higher earnings growth. And what this research paper says is that when current payout ratios are high, earnings growth is the fastest. When current payout ratios is low, it's actually slower earnings growth. And this goes against a lot of cherished notions that I learned in finance, right? So basically what Clifford Asness, who is a billionaire, right? He's a billionaire, founder of AQR Capital. He's not a, he has a PhD, but he's not an ivory tower kind of professor, okay? And so what he's essentially saying is that companies, these cash cow companies with very down-to-earth managers who return money to the shareholder, they are run better than companies with these flashy managers who take the cash, decorate their offices with art, install golden taps. So overall, you find that these very down-to-earth kind of managers begin to outperform the flashy managers who like to play politics and build their fiefdoms, right? So with this paper, I realized that, hey, I can start doing something different about my personal finances, even after spending 3 years studying finance, right? I was like in the middle of nowhere. So one of the earlier investments I made close to 20 years ago was SPH, right? SPH is no longer around. It's caused a lot of umbrage for recent shareholders, but many years ago, it was about 4 Singapore dollars, and it regularly gave 6%. And the bulk of the dividends came 4 days before my birthday on Christmas, right? It came on the 21st of December. And that was when I figured out that your life can change if you know how to play this game, right? All I needed to do is, instead of just buying one company like SPH, what if I bought many, many companies, right, like SPH? And then if I'm able to do that in scale, I would be able to eventually, right, sustain my expenses using these investment income that I have. So my expenses is a horizontal line I'm drawing over here. But the dividends that I'm receiving, I could build a exponential dividends curve here. And once I reach this point, right, where I can cross over, where I can live totally on my dividends, I would be able to do a lot of things in my life, right? That ordinary Singaporeans could not figure out how to do. Now, this is common knowledge today, thanks to the FIRE movement, right? But when I was in my 20s, there were very few books on it. And the book that talks about it was very boring, right? The Vicky Robin book, I read it and I found it hard to read. But fortunately, I was able to figure out this game, right, using dividend stocks and financial independence. So in my mid-20s, I began to make changes in my life so that eventually I would be able to become financially independent at that time. Okay. And so if you were to really think about your life in summer, right, you realize that the problem of working is that you're not as engaged as before, right? Chinese workers now, they are struggling with a lot of youth unemployment. They have this term called 人矿, human minerals, right? They see themselves, right, as something to be exploited, enriched and then exploited, and they are a means to an end. And this is a whole evolution, right, of the Great Resignation movement that began in the US. Subsequently, it went to China, where people talked about lying flat. And so a lot of questions, the people who come for this talk today, you want to ask yourself, can I get a more relaxed lifestyle instead of just slaving for someone else? Now, remember, if you work very hard this year and you achieve a lot, right? Yeah, you would have effectively paid for your bosses like European car, right? So that kind of mindset, right? At the same time, when you're going through summer, the financial institutions want to have control over your investment strategy. They've trained a very motivated pool of financial advisors. They will call you, they will ask you out to go to McDonald's, and then they will try to convince you to get some of their products. Now I heard that they are in dating apps. They're waiting for you in dating apps. And my friend who went for like a wine appreciation session as well, the person who is the wine expert also wants to sell insurance to him, right? Yeah, so they're everywhere. And it's like, I don't know whether you follow the Marvel series on Secret Invasion. They're like Skrulls, you know, anybody could be a financial advisor, right? And of course, the half-life of your knowledge is getting shorter and shorter. And right now, I'm obsessed with ChatGPT. I'm trying to build a new generation of developer tools for this training program, right? And the half-life of your knowledge is becoming shorter and shorter. So you realize that when you earn an engineering degree, it might last 6 to 7 years. My time, I've got some friends, they're still engineers today after 20 years, right? Mortgage takes many years to pay up, so your mortgage, you got a 30-year mortgage, but your career is like 6 to 8 years, right? And you don't have a lot of time, right, to maintain your kind of value in the economy, right? It's a huge mismatch. So you earn the most in summer, but if you don't conserve it or find some way to save it, right, there are a lot of people, that want to mess with it, like in Mandarin, they call it 打你的算盘子, right? Which means in English, right, to basically to take the abacus, and calculate for you, how much money you should ideally have, right? That's very bad, right? I mean, as an ethnic Chinese, I don't allow people to beat my abacus, right? That's why I'm in the business of training you on how to do it yourself. Okay. All right. And so now the myth in summer is that the idea is that you won't be able to retire unless you listen to an advisor. All right. And I'm adamantly against this particular myth, and I urge you guys not to listen to it. And in order to do that, I will share with you some of the model assumptions to retirement. Okay, so there are three things you need to know about your retirement in Singapore. All right. The first thing you need to know is you need about $500,000 to retire. And how do I derive that number, right? In finance, it's very important to show you're working, right? Because if you were to just show your answer, that person might be selling something to you, and he might give you the wrong answer, or he might give you an answer that is the most appropriate for himself, right? So the Lee Kuan Yew School of Public Policy in 2021, they said that a single person at age 55 needs about 1,768 a month to lead a dignified life, right? So we take the number. we annualize it by multiplying by 12, and we divide it by 0.04. 4% is a safe rate of withdrawal. There is an idea in the industry that if you have $1 million in the stock market, you can spend 4% or $40,000, adjusted by inflation every year. And you won't run out of money for 30 years, right? So that's how they do retirement planning in the industry. So I plucked out that 4%, I plugged it into the formula, and we have about $530,000, right? So that is the $500,000. So where it comes from, right? If you want a safer rate, like you prefer 3%, then accordingly you need a larger portfolio size, right? So that's the first assumption. Now the second assumption is that you don't have a lot of time in order to save that amount of money. At the age of 25, you get a 4-year degree if you've completed NS. When you start work, you might take some time exploring the workplace, and because the half-life of your knowledge is so short, right? A lot of engineers like me start thinking about like getting an MBA, right? So if you get an MBA, you waste another like 2 years of your time, 1.5 years of your time. Likely, if you're smart, you go to INSEAD, there's only 1 year of your time, right? And then after that, when you graduate, you start at the age of 30, you might be in a little bit of debt, but you're making money the first time in your life. Now, you fast forward to who's getting retrenched, right? For Generation X, we get retrenched sometime after the age of 40, right? But I think the tech workers right now, who are millennials, right, largely younger than me, they're getting retrenched maybe in their late 30s or 35, right? So what I've done is that I've arranged these things on a timeline, and you realize that the time frame you have to do retirement planning, for many cases, is only about 10 years, right? You got 10 years of really saving very hard to plan for retirement. Otherwise, when you hit that zone, right, where life becomes very unpredictable, you might get, you have to go through the 3 Rs, right? You get retrenched, the government will make you reskill, and then you get re-employed, sometimes in a totally different industry, right? So I think that's a game that SkillsFuture tries to play with a lot of Singaporean workers. I'm not saying that's wrong. I'm in support of SkillsFutures, but like I said, what I'm trying to do is to provide a better alternative to retraining and SkillsFuture, right? And that you only need to do that when it's absolutely necessary. The third assumption is you can save about $2,000 a month. And I take this from data on existing median salaries in 2020, which has gone up quite a bit. So if you take 50% of your take-home pay after CPF, you should be able to save about $2,000 a month, all right? So with these 3 assumptions, right, we can do a lot of magic, right? With a little bit of maths, you do a lot of magic, right? So the first thing I'm going to do is that I'm going to show you the kind of products that insurance agents can sell to you and see whether they let you meet your retirement goals, all right? So let's look at insurance products. So if you can save $2,000 using an instrument that will produce 2%, like for example, an endowment fund, right? We can use the compound interest calculator. We keep we set it to 2,000 a month or 24,000 a year, and we keep increasing the number of years until the future value hits $500,000. All right, so we do this. We can derive the number of years it takes, right, to meet your financial target. All right, and if you do that using a short-term endowment, right, it will take you 18 years to do that. 18 years, which is much longer than the 10 years that I've been telling you about. Now, if you get a long-term endowment that gives you 4.25%, and that is what they call based on the benefits illustration, right? You can improve your chances by lowering it to 15 years. But these are not products that give them a high commission, right? What a financial advisor really wants to sell to you, and why they're so eager to catch up with you after many years, I'm not seeing you, is the investment-linked policy, right? The ILP. ILPs are very hard to understand because there are many penalties embedded in the contract, right? In the illustration. So what I'm going to do is that I'm simply going to assume that it's a very good ILP. That on average, after deducting your commissions, your administration fees, over the long term, you get 5%. 5% is already very hard to achieve for an ILP, all right? If you read a lot of blogging reports and all that, right, you generally can't even beat inflation. Okay, so if you have a 5% return, then using the same process, right, where you use a compound interest calculator, you will get out the rat race at around 14 years. Okay. So what am I trying to say, right? I'm trying to say that no matter what a commission salesman were to sell you, you won't be able to meet this aggressive timeline within a decade. So that's a problem, right? Unit trust, I've decided to give the unit trust salespeople more face, but the problem is that if you have a 10% return and you pay 3.5% in terms of like management expenses and commissions over time, you won't make a lot of money either. And at 6.5% returns, right, which is a global equity fund over the very long term, you might still take 13 years for you to meet your objective. All right. And these numbers are very generous. I'm making these numbers, I'm biasing it towards the industry and giving them the benefit of a doubt, right? And still, you won't meet the 10-year timeline. Okay. And this is largely due to trailer fees, which are kicked back as sales commissions, right? So what am I trying to tell you, right? Is that if you give up your control over your financial destiny, you will fail, right? You will not succeed in the journey towards early retirement, right? Now, what really happens is that there is a conflict of interest. You want to save as much money as you can. The person selling you the product wants to make as much money as they can so that they can retire on time. And so this is a conflict, right? And in a conflict, only the regulator can come in to moderate the issue. And at the end of the day, no one wins, right? So if you want to save more money, then there'll be fewer financial advisors to serve a larger population, right? Okay, so now what I'm going to do next is that I spend a lot of time criticizing an industry. I'm going to show you guys whether is there an alternative. Is there an alternative to all this to make things a lot easier? All right, to make life easier for everyone, I need to explain a couple of basic concepts to you. When we look at an investment, there are two things that we look out for. One is returns, and for returns, the higher the better, right? So if something gives you a 7% return, you put in $1,000, you get $70 at the end of the year, right? But there's this thing called a standard deviation. So the higher the standard deviation, the more unpredictable the stock price is, right? It measures the average distance between the mean, right? On average, how far is the return away from 7%? Okay, so that's the standard deviation. I'm going to demonstrate why we want a high return and a low standard deviation next. All right, so I'm going to stop my share. And I'm just going to switch over to this program. All right, so I do a little bit of coding, and this is one of the means to use Python programming code to teach some basic concepts of personal finance. So we have about 500 retirement portfolios on this chart. Not every retirement plan is going to succeed. Okay, generally there is a failure rate. So 10% of these portfolios will fail. That means you enter negative territory once throughout the life of these 120 years, right? So what I can do is that if I can find an investment strategy that will improve my return, right? So say I set my returns higher, it will obviously lower the failure rate. Okay, you lower the failure rate. Okay. Now, what people don't realize is that if you were to increase the standard deviation, if you make the underlying risk higher, right? As the underlying risk goes higher, your failure rate also goes up, right? So that's why when we look at an investment, strategy, we want high returns and we also want lower risk. Okay. Why I like Singapore stocks and I illustrate them, you might ask, because no capital gains or dividend taxes, no problems with estate planning if anything happens to you. All right. It's fairly simple, it's straightforward. Go to CDP, transfer the shares to like the children, right? Yeah. So Singapore stock market, people joke about it, people laugh at it, but the Singapore stock market, when times are bad, has outperformed the US markets in 2022. Okay. So don't look down on Singapore stocks, and I think that Singapore stocks are excellent. So let's begin with a very rookie kind of strategy. All right, you buy the Straits Times Index in the form of an exchange traded fund, and what you do is you buy one counter, you get all your Temasek based kind of counters, all the big DBS 6 REITs, they all come together. You can buy them all in one shot. Okay, so suppose you do this, right? You buy this STI. If you have done this for 14 years, right, up till last year, December, you would have earned 0.9%, right? It would have taken you 19 years to hit $500,000, right? So 19 years to hit $500,000, what does it mean? It means that you are better off listening to a financial advisor than just picking rookie strategies and buying like an ETF, hoping that you can retire based on that, all right? The problem with such an arrangement is that the ETF is structured in a bad way. It is capitalization weighted, which means that when you buy STI, 45% of your funds is stuck with DBS, OCBC, and UOB, right? The 3 banks, because they're the largest companies in Singapore. And now with interest rates stalling, right? You find that DBS, OCBC, and UOB has gone up in the past. They're not going up anymore. In fact, they are slowly drifting down, okay? So your performance, if you were to do this, doesn't look good for the rest of the year, right? Now, how do you improve your performance? It's very simple. You disaggregate. Instead of buying one ETF, you take your money, $300,000, split it into 30 parts, $10,000 each, and you buy every single component of the STI, right, that I show you on this newspaper. If you had done that for the past 10 years, you would have improved your performance, right? Over the same time period, 5.4%, right? So from 19 years, you improve your retirement planning to 15 years, right? Equal weighted STI counters. Now, you might be asking yourself, right? So if I do that, is it possible to not buy all 30? I buy some, and I buy some that I think might be able to outperform. I say, yeah, and that's what people do through this thing called factor selection. We select stocks that have a lower price to earnings ratio, lower price to book ratio, higher momentum, right? And we shortlist them and we see how they perform, right? We shortlist 15 of them. So in this example, I talk a little bit about dividends investing, right? Because it is the most important factor for people that are playing this FIRE movement thing, right? They're playing the game of financial independence. So what you do is you go to the newspaper and you pick out 15 stocks that give you the highest dividend, right? So if you do that, right, over the past 10 years, your performance improves to 7.9%, and it will take only 13 years for you to hit your retirement target, right? So in Singapore, at least, high dividend counters actually will shorten your retirement, right, pretty substantively. So you say, oh, cool. So now I can get 15 dividends. Is there a way for me to improve the performance further? 15 is still a lot, right? I'm a retail investor. I said, okay, if you want to do even better than that, then you need special computer software to apply multiple factors. So for example, if I want to improve my dividends kind of performance, I might want to include introducing high net profit margin into my measurement, low price to book ratio. As I combine these factors together, I shortlist maybe 8 stocks, and then I see what kind of performance I can get. All right. So if choosing one factor works, right? Choosing multiple factors might do even better, right? Yeah. So let's see what happens when we execute this 3-factor model. So if you take 8 stocks with a high dividend yield, low PE, low price to book ratio, and high profit margin, you finally can find yourself with double-digit kind of returns. And you're able to grow your wealth and hit your target within 11.4 years. All right. So that basically sums up the procedure on how we can actually retire early, right? So if you want to push Beyond 10 years, right? The second part of the evening, I will talk a little bit about it. Okay. So for summer, for now, right, we just realized that by leveling up your investment knowledge, you can come up with better returns. Okay. Okay, the numbers here are a little bit different from the slide. Okay, I've not updated it yet, but you start with a low return for the STI ETF. Then when it's equally weighted, your returns go up to about 5%. When you have high dividends, it's about 7 to 8%. And then when you actually pick multi-factor models, right, you can hit about 11.3. All right. And if you want to go higher than that, well, that depends on the amount of risk, right, that you want to have. Some of the points that you want to make during summer is, how can I maximize my earnings? Can I afford to settle down? How long are good times going to last? Can I sustain this pace of working life? And can I trust another person to manage my finances? These are all very important questions that you want to ask yourself in summer. And so this is the longest discussion among the seasons. I'm going on to the third season now. The third season is the season of autumn. And this is where your life begins to slow down and you reach middle age, right? It is also at this point of time where you need to be very careful about your mental health. Your happiness reaches an all-time low. And I know this week everybody's shaken by the news of Coco Lee's death. So Coco Lee herself is going through a very difficult summer. And The Economist talks about people having the unhappiest period of their life at the age of 47.2 years, right? And Coco Lee is 48 years old, right? So when she passed on. So yeah, if you have a little bit of all this information on psychology and social science, it really helps you like put all these news into perspective, right? And let's begin with our discussion. So for me, I began to make a series of career mistakes as I was entering my autumn years, right? When my daughter was born, I thought that by going from the private sector to the public sector, I would be able to get more work-life balance, right? Unfortunately, that was not the case. I found myself in a very elitist and toxic kind of work environment where the managers like to have a favorite group of blue-eyed boys. They're basically scholars. So there was one engagement I have with a senior manager, and I was talking about this programming language called Ruby on Rails. And I was telling him that you could build a website with a functional database front end, one line of code, right? One prompt command, I'm able to do that, right? Those days, it was 10 years ago. So not as amazing as what we can see today. So he didn't believe that was true, and he's a tech dinosaur. So we went on back and forth. And he doesn't know that I actually code, you see, because he thinks that government officers don't code, they are project managers. So it went back and forth until he decided that he's losing the argument. So he asked a scholar to join him, right? So there's a young scholar from an Ivy League university, solid data science credentials. And he said, who's right, me or Chris? I was thinking, you're 4 ranks higher than me. And you're pressuring your subordinate to pick sides on who is right in a technical discussion, right? So I say, if I'm a scholar, I'll just throw the uncle under the bus. And so what the scholar did was, surprisingly, he said, actually, I can do what Chris is talking about, and he's right. So, sorry, I just recovered from a cough. So I got saved by the scholar. But here's the funny thing, right? After being saved by the scholar, you thought the director would begin to pick a fight with the scholar, right? No, the scholar is his blue-eyed boy. He actually said that, okay, if you think Chris is right, Chris, your proposal is approved. Yeah, and I was so angry after that debate, right? So my 14 years of working experience didn't matter squat to your organization. And all it takes is a scholar, a young guy, with less than half of my working experience. All he has to do is say, yes, I think he's correct. And everything is approved, right? So I felt really aggrieved. I needed to get out of the organization, right? And I've never seen something like this in my years in the private sector. It's never been so elitist. And so a couple of years later, a couple of months later, I got into serious trouble this time because I was sort of a marked man, right? Given that I speak the truth and I'm very technical, and I like to argue on the technical merits of something, and I do not give way to politics, right? So because I was a marked man, I was called into a room and my crazy lady supervisor started shouting at me at the top of her voice, and it was almost like vulgarities. It was a glass panel in the organization, right? Maple Tree Business City. And the shouting was so bad, the whole room could basically hear me getting shouted at, but I didn't know what was wrong, right? Normally, when an employee does something wrong, he would know, but I genuinely didn't know what went wrong. So I wanted to inquire, right? So my default state was I was curious. So as it turns out, my supervisor was picking on me because I was too fast starting a project. I said I didn't do anything wrong. I was just too eager to get the project going, but I wasn't eager. I was eager because my customer was eager, and my customer was a ministry. They wanted to get the work done. So I said, okay, so you don't want me to actually start work on this, and you want me to do the paperwork, right? You say, you find me the paperwork. I said, look, PMO organizations have a form for me to fill. But I've been looking for that form for months. I don't have a single form. Without that form, I can't do the formalities of launching a project because we are not taught how to do that, right? Yeah. And so I also help me with the form. I'll get the work done, and then we will hold a meeting to start again. I was an adult, right? I mean, a relationship. I say, look, I admit I'm wrong. If you were so angry, you might as well admit that you're in the wrong, right? Instead of helping me find the form, she carried on shouting at me, and that was when I realized I had it, lah. It was a straw that broke my back. And so I just looked her in the eye and said, fuck this shit. If you can't help me do this and you just want to shout, I resign, right? I'm going to tell you the science behind this, all right? So mathematically, by then I had wife and kids, right? This is my family expense. This is my dividend. This is the salary that I got as part of my job, right? My dividend is somewhere here. So I can credibly feed my family without a day job, all right? So I was able to fire my boss, right? And I think at that point of time, really, I think it's such a dysfunctional agency that the agency no longer exists. Don't try to guess which agency it is. Okay, I think if you work for the government, the agency no longer exists. The three alphabets no longer exist. All right, it comes under a different name now. All right, and that's the end of my career. That was 10 years ago, and that was the last time I drew a salary. Obviously, my adventures didn't end then. I had no job, 14 years of IT experience. I can support myself. I decided to do something that a lot of IT people didn't do. I wrote a letter to SMU. I said, I want to be a lawyer. Lawyers have been so annoying. They've stopped me on a lot of my project initiatives. What's so special about lawyers, right? So let's study law. I went to SMU. I spent 3 years there. Then 1 more year to get my practice training. I got admitted to the bar in 2018. And my journey wasn't over. My problems have only started. I tried to do law, but the practice of law is different from the theory of law. I hated doing divorces, right? Couples that don't listen to you, unhappy people. Most of the time, 90% of the time, people who see lawyers are unhappy people. So, I decided after a night, I got scolded by a legal partner for taking a shit in the afternoon. And I decided that I wanted out. And so Dr. Webb offered me this role to teach investing. After all, I've sort of mastered the game. And so here I am. I've been teaching this course for the past 4 years, right? So here's something interesting that happened in law school. A lot of people were studying very hard, right? I found that there were Bloomberg terminals in SMU. And that was when I did a lot of quantitative back testing to test investment models, right? I wasn't studying that hard to find out which of the models that worked in the stock market, right? And on top of it, right, I was facing a couple of problems as a law student. I have to pay my school fees. I have a family of 4. My wife doesn't work. I have a mortgage, right? So what did I do to resolve that problem of supporting all these initiatives while not having a day job, right? My dividends are there, but dividends is not really enough, right? So I discovered leverage. So with these finely tuned investment models, right, I was able to put my money and borrow money from a broker to increase the amount of dividends I got. So the amount of dividends accorded me a very comfortable kind of lifestyle during my 4 years through law school, right? And I was able to solve that frustrating problem of people who are like spending their time getting a master's degree, right? How the model works is that most people save up a bunch of money, 200 to 300K. And then what they do is they study for an MBA and they get a loan for the MBA. And then they spend down their money. Then on the last day they graduate from school, they are in debt. They may have a negative net worth, but the MBA lands them a high-paying job, right? And then they start all over again. They pay off their loans and then they buy a house, and so on and so forth. That model doesn't work for me because I'm in my 40s, right? So the model I employ is I have an investment portfolio that supports my family and gives my family a certain amount of income every month. I leverage it slightly, not by a lot, slightly, to increase the amount of dividends I receive every month. That amount pays for my school fees, supports the mortgage, pays for my family expenses, right? Now, at the end of my 3 years of law school, my net worth was higher than the point at which I entered law school, right? So that was how you're able to beat this problem, right? Of supporting yourself through an advanced degree, and at the same time, you can sleep well at night. Now, if you look at your own Autumn, right, you find that right now you're struggling with your inflation numbers, which are very rough. You're talking about inflation closer to 5% than what's on this slide. This slide's a little bit old. And you're dealing with like problems in Russia. And now the problem has evolved. It's no longer about the invasion of the Ukraine. The problem is that if the Putin regime collapses and Russia falls into a rebellion, right, there'll be turmoil in the commodities markets again, right? And so big problem for you, your kopi O kosong is now $1.30. If there's turmoil in Russia, you know, it might edge up to 150, right? And Singapore inflation is already very high. So you really need to worry about these things. Job searching in Autumn is very hard. I recently got rejected for a job because I thought this job gels very well with my business. But the company liked my profile, but the company cannot tolerate that I'm also a businessman in the evenings, right? So job search is very, very hard, okay? And you find that it's like dating, right? In your 20s, you date beautiful people, interesting people. In your 40s, you go on a Tinder date, you only get weird people, right? It's the same for jobs. Okay, there's ageism. If you look at the amount of pay that they give based on your experience, right? It goes up 5% for every additional year that you have. But then what happens is that based on the government data, it flatlines. So at around 45 years old, it falls flat, right? It falls flat, no longer improves anymore, right? So something happens at the age of 45, right? It's quite mysterious. So there has to be some kind of discrimination because there's no gentle curve, right? There has to be some kind of discrimination where maybe they feel that you're too expensive, you know. So now with like artificial intelligence, the shape of the curve may fall flatter, right? It may fall flat after 35, for example. And of course, for people my generation, you have to divide your support between parents and children, right? So that the elections 3 years ago, when they lost Pongo, right? When they lost Sengkang, right? Lawrence Wong said that it is based on the economic pain that is being felt by the people who are middle-aged, right? So yeah, so I think that's the problem. So what can we conclude, right? In Autumn, you're no longer in your earning peak, you're facing retrenchment in the workplace, and you also tend to lose your parents at this stage in your life. So it's very, very hard, very, very miserable, right? So I lost my dad 4 years ago, right? So I know how it feels. Okay, so the myth in autumn is investing is too complicated and can distract you from the realities of life, right? I mean, a lot of people want to say this kind of thing so that they feel good about themselves for not having done their financial planning. And you also want to convince you to outsource to the industry, right? Now, the truth about dividend counters is that often a lot of them malfunction, right? Asia Pay Television Trust 2018 slashed dividends by 80%. Eagle Hospitality Trust basically committed almost fraud, right? And even Maple Tree North Asia Commercial Trust, it no longer exists. It's merged with another REIT. Protesters in Hong Kong burned down a Christmas tree in one of the buildings. And it created a lot of stress for people who invest in these counters. Right, of course, and during the pandemic, the data center REITs did very well, and that created a different set of problems, right? Do you sell at its peak, right? So on hindsight, the answer is yes, I should have sold, right? So these are the questions that will constantly bother you when you deal with these REITs, right? So what's a simple way to make it work, right? How to simplify it for the guys this morning on a Saturday is just try to get your dividends, all right? Stay calm, collect your dividends. Start with a very simple goal of $100 of dividends every month, okay? Now, if you invest in the stock markets, it will currently give you about 5% dividend yield if you pick the right kind of stocks, right? It's not difficult to do that. So it's enough to cover your basic living expenses. And so if you take $100 every month or $1,200 a year, divide it by the 5%, it basically means that you need $24,000 to get started. $24,000 to get an investment portfolio that would churn out $100 every month on average, right? And this is your first golden goose. Okay, it's a golden goose. It lays $100 of golden eggs every month. And you can get a golden goose after 1 year of saving $2,000 every month. So this is definitely achievable for many Singaporeans. And before you want to discuss the merits of this strategy, go for this first. Do it yourself, right? Now, once you get your first golden goose, life will become better because the first golden goose would have increased your take home by 100. And that amount will then increase every year as you get more and more golden goose. And so by collecting your golden goose and getting them into a flock of golden geese, you are building your passive income and getting financially independent. All right. So that's how you use compound interest to get where you want to go. Right. And so the message in autumn is get your golden goose, right? Get started as soon as you can and get $100 of passive income. Never say things like, I'm in my 50s, is it too late? It's not too late to get your first golden goose, right? And your life will instantly change once you're able to do that, right? Question in autumn would be, am I the next to be retrenched? If so, what can I do to survive? If I give support to my parents, what happens to my children? Which CPF life plan should I choose? And why am I so unhappy and miserable, right? Very common to ask these questions, and it aligns with all these world affairs. Okay, and finally, before we take our break, talk about our final season, which is about winter. And winter is the last stage of your life. You enjoy the fruits of your labor, and then your happiness goes up again. All right. So right now, my life is it's quite simple. I work maybe 2 days out of every week, and this is my family trip to Australia. I don't want to create the kind of myth that financial independence, it's about traveling, having a cocktail, watching a sunset. I think that misrepresents the kind of financial independence that I would like my students to have as well, right? The trip to Australia was tiring, and we spent a lot of time running after my son. So when people ask me, how's your holiday? When I came back, I say my holiday is just started because I'm back, right? Yeah, so travel is actually quite rough for me because you don't have stress at work, right? Travel becomes much more stressful. That's what a lot of people tell you. I prefer to focus on simple living, right? And so I like to talk about two kinds of financial independence, right? So this is a kopi guyu that you can find at Lavender, where I go to a hipster place called Hiap Seng Leong, a very old school kind of kopitiam, and the meal cost me like $2. Now, why is this kind of financial independence important, you might say, and why is it so cheap, right? The answer is we are not focusing so much on how cheap it is. The fact that I'm on a Monday afternoon having a coffee and nobody can control my time, that is valuable, right? That is the valuable part of financial independence, right? So I'm going to share with you two other aspects of it, all right? One is my son Durando goes to primary one. I bring him back from school every day. So I built a close bond with my son. I couldn't build my daughter because my daughter was schooling when I was working at that time, right? So it's a very different kind of relationship. Second one's obviously quite much sadder. My dad left this world 4 years ago, and in his last days, I basically was seeing him every other day in the hospital. And imagine if you're financially independent and if you're not, and you gotta seek leave, right, to do that. Yeah, that's quite a bummer, right? Yeah. So the financial independence allowed me to spend like my dad's last days, closer to my dad. All right. So the message in winter is that your overall expenses will drop by about 30% from 55 to 65, and most of your money would go into home cooking, furnishings, and your personal health, right? So you need to look out for all these areas of your work. And the other problem is Singaporeans have a long life expectancy at around 85 years. You're healthy up to about 72 years old. And then after that, living too long becomes a possibility, right? So you need to be very, very careful. The health span is 72 years. The lifespan is 85 years, right? Even worse is the problem of CPF, where if you follow the government very faithfully and you put in $200,000 into your full retirement sum, even under the highest paying plan, you get $1,000, right? About $1,000, but your cost of living is about 1,004. There is a shortfall between the cost of living and how much you can get from your CPF life. Even if you like follow the amount that you're supposed to keep based on your full retirement sum, right? So that's a major headache for a lot of people that think that, maybe one day I can live on your CPF, but the truth is that you can't, right? It doesn't provide enough for you, all right, for a dignified kind of lifestyle. You still need about $500 to $600 from some other sources. You need to tap on your children, or you need to tap on your investments to do that. All right. So the lesson in winter is it's already too late, right? You reap what you sow in winter, and this is what happens in your stage, all right? And winter is coming for everybody. Now, the myth in winter is that market crashes can destroy your life. So to address the older kind of participants here, I'd like to talk a little bit about the Great Recession of 2009. And at the time, I worked in an exchange, nice 5-figure kind of salary. Everybody was spending and enjoying their money during the recession. Markets crashed. I was doing the opposite. I was taking my whole paycheck, 100% of it, because I was living on my dividends, right? And I was like pumping it back into the stock market every month. And this was a very, very tough time, right? I was losing money and having a lower net worth throughout the entire period. Even I was making a nice round salary and I was being laughed at, right? So I've lost an entire BMW to the stock market. Colleagues were laughing at me, right? But I learned something that they don't, right? And one of the things I've learned is that I know how long these recessions last in the past. So with data, I realized that the longest recession we ever had was the Asian currency crisis in 1996-97, 706 days. What this also meant is that when you are faced with a market crash, all you have to do is to stay calm and buy more. If you stay calm and buy more, eventually the markets will recover, right? And so that's what I did, right? For this 2007 period, it only lasted 515 days. So eventually the markets recovered. And when it recovered, I was the only guy in my office who's fully invested, right? And so I was telling my colleagues, the BMW I lost in the stock markets, it came back as a Maserati, right? Yeah, so market crashes are your airline wealth building. If you go back in time to December 2008, you realize that, hey, there are all these REITs, right, that are giving double-digit amounts, right? And ESR is giving 21%, right? This is actually AIMS APAC REIT, 36%, right? So if you were to accumulate these dividend-generating kind of counters, right, when markets are down, when markets recover, the dividends will compress. And when that happens, you become a millionaire. Yeah, so that's basically what happened, right? I made my first million after the crash. And now, if you look at the real estate investment trust world, the yields are high again, right? You're getting double-digit yields. Of course, you're going to get more risky instruments, US officers and all that. But there are ways to moderate your risk if you understand like the underlying business, right? Like Keppel Pacific Oak, they don't invest in these gateway city kind of officers. They invest in the second tier cities where there's a lot of emigration from California, right? So you don't see the kind of problems with vacancies compared to what you read about for commercial REITs in the US, right? So there are plenty of opportunities for bargain hunting now, right? And of course, the equity risk premium is very, very high now. So this is an excellent time for everybody to get into the stock markets. People just don't know it yet, right? So I think winter, we need to understand that, these market crashes are your ally in wealth building, right? And that you can become very wealthy if you were to put your money in at that time. Some of the questions you want to ask yourself in winter is, can I quit my job? When will I die? Will I be a burden to my children? Who will I grant lasting power of attorney to? And what legacy will I leave my children? Right? Okay, so we've come to the end of the 4 seasons. There are 4 points that I've made. The first is, some people think that your X factor can come from reading popular finance books. And the answer is no, right? You need to invest the time to learn finance the hard way, right? There's some mathematics involved. There's got to be a lot of theory crafting, right? When you learn how to invest. Second point is, retirement is impossible unless you listen to an advisor. That's bullshit. And retirement is possible if you're willing to level up your investment knowledge. I've showed you how it's done. Third point is, investment is too complicated, can distract you from the realities of life, all right? And getting your first golden goose, all right? All right, that would be a simple way of summarizing everything. And finally, market crashes can destroy your life. Well, that is true. Market crashes are also your ally for you to build great wealth, okay? So these are the truths to counter the 4 myths, all right? But what am I really driving at? The Singapore dream is dead, right? You know, that old model: go to school, get good grades, then go to university, find a good job, work your way up, accumulate the 5 Cs, and then retire at 65, when CPF life comes all the nine. At every single stage of the way, right, there are not obstacles that if you're a millennial, you will understand, right? It's very difficult to actually meet all these objectives, okay? Yeah, the traditional method is failing. I present to you the new Singapore dream in the form of dividends, okay? And this is what dividends can do for you, right? In spring, support your children's education. In summer, ease out your minor expenses, smooth out your lumpy salaries. In autumn, address sudden expenses related to education and parents' medical expenses, cope with retrenchment, facilitate career pivots. In winter, hedge longevity risk, pay for medical expenses, prevent yourself from becoming a burden to your children. All right, and this is how dividends can appear in your bank account. So in the worst part of the pandemic, I've recorded the dividends I received in the second half of 2020. This is what you can achieve if you have done so for like 15 to 20 years. All right, you cannot do it immediately. It will take you many, many years to do this, and you need to do fairly well in your career to accumulate a portfolio of this size. All right, so for that half a year, 6 months, I collected $80,000, and it's based on a portfolio size of approximately 2.4 million. That's about 13,000 a month. All right, about $13,000 a month. From a yield perspective, it's yielding 6.6%. Right. When I did the slide, the median household income is only 7,700. If you convert 2.4 million into a condominium, you can probably get rental of about $5,000 to $6,000 a month. All right, should be a little bit slightly higher today, but generally speaking, the dividend approach, right, gets you more passive income in your pocket than the real estate approach. Then, like for example, buying a condominium, right? So generally, this is what it is. We've come to the end of the first part of our presentation. In the next segment, we'll spend a little bit of time talking about what kind of strategy will get you to retire in 10 years, right? The golden goose cheaper, how to shrink portfolio volatility so that you can sleep well at night. Okay, and it is now 10:07. Let's come back at 10:12 to conclude the presentation, all right? Make yourselves a cup of coffee. We will be back at 10:12. Okay, welcome back. All right. Over the next 30 minutes, I'm just going to spend some time talking about what is the early retirement masterclass. All right. This is a 5-day course, all right, to recover the Singapore dream. And there are 3 objectives. We want to transition our student into an independent and successful DIY investor with support from a growing like-minded investor community. All right, we want to create a secondary source of income that will meet your lifestyle needs. And we also want to give you the ability to use a data-driven framework to grow your portfolio in an ever-changing kind of work environment. So what kind of outcome do we want, right? We want a portfolio of local stocks, 15 to 20 counters for diversification. We spread them between blue chips, REITs, and business trusts, designed to provide about 5 to 6% dividends every year, consistent with our view of the market cycle, right? So you build it once and you leave it for at least a year, all right? So minimum monitoring. You build a portfolio and then just let it run for 1 year. It generates income for you. Then the next year you buy more so that over time, you'll be able to build up your portfolio. I've not really spoken about how to get within the 10-year retirement mark, okay? But I'm just going to give you a hint, right? I cover this in greater detail in my program, but the hint lies on leverage, right? So if you can borrow money from a broker at a low rate, okay, you can increase your return from about a double-digit number that I've shown you earlier on to about 18.6%. Now, if you're able to do that, right, over a very conservative portfolio like the one that I've shown here, right, these are very conservative stocks, okay, you can get 18.6%, and that kind of number will push you over the 10-year mark, all right? So leveraging that portfolio of blue chips with high dividends, low PE, low PB, and a high profit margin, generally that will allow you to be able to reach your target within 10 years. Now, leverage is very dangerous to execute right now. So this is entirely optional, right? So only a very small fraction of my students practice leverage investing, but we do teach them how to do this in my program, okay? So a little bit on how we prepare our students, okay? We have foundational training, 4 days online, okay? 4 days online. And then after that, we will meet face-to-face on the last day. We will run these models and you'll be shown how these models work. Then we will break the class down into different groups. And after we break them into different groups, they will do a research. They will come back to discuss what gets into the portfolio, right? Once we get the portfolio base after you perform the short listing, then I will take part of my training fees and I will invest it in the portfolio that you build, all right? So it is a closed feedback loop, all right? I teach you, then using the knowledge that you have taught, you tell me what to buy, and then I take the trading fees and I buy it. So if you make a mistake, I lose money, all right? So that's how the whole system works. It is a serious course, right, where there's stuff to learn, all right? You're not supposed to understand this slide because these are just fragments that I've taken from my lecture notes, all right? So there is some very simple maths, plus, minus, divide. There are also some amount of number crunching, but it's easy once you know what they mean, okay? Yeah, so we spend a lot of time on that during the 4 days of online training. When we meet face-to-face, no, we are building a portfolio. We are figuring out how to invest our money, right? So there's a different kind of process that we go through. Okay. All right. So I have written a web app using Python to turn a room of students into a team of financial analysts. So as you collect information on the various stocks that you have in the market, you are doing data entry for me. And what the tool will do is that it will take your investment decisions and finalize the properties of the final portfolio that we're getting into, all right? So there is a tool to consolidate all your qualitative analysis. The class will participate in 2 rounds of portfolio creation. The first round will give them a list of blue chips. The second round will give them real estate investment trust, all right? So collectively, both of them will generate a decent amount of dividends for an investor, okay? And typical dividend that you will get is right now, you will get more than 6%. So this is an older portfolio. So the portfolios that you build, right, you're likely to be able to get 6% from it. And there's all this financial information that will be generated by my web app. They'll perform all the calculations for you. Okay, so you don't have to think about all these numbers. You just need to learn how to interpret these numbers, right? And so that allows you to make the best investment decisions. And you can also there is this very annoying clear all drawings. Okay. Okay, and so this contains a fragment of data that has been entered by previous students. You can see that the research can be quite thorough, right? So we teach them how to go through an analyst report and how to summarize all this data in a company. Very likely, what I'm working on is before September, we implement ChatGPT into our regular processes of training students. All right, so I'm working on it right now. Yeah, it's a lot of work, right? Yeah, so right now this is done by a student. Maybe the future part of this can be done by ChatGPT. Okay. Now, the output of my web app is a PDF document that contains a list of stocks that can be executed in the markets the following Monday. All right, so there is a certain beauty on how to put money into the markets. Okay, and if you take this 17% that my students have back tested and all that, even without leverage, right, you can hit the 10-year mark, right? You can take 10 years to grow your wealth into $500,000. And right now, as the markets are quite bad, right? If you were to do the bargain hunting now until the beginning of next year, there is a very high probability, and I have the numbers to back me up, that if you can sustain this for 3 to 4 years, you will see some very, very positive double-digit kind of results, right? Okay, you might want to know how we are doing right now. Okay, so I've been running the course for 4 years. Okay, our performance is not negative, right? We are still in positive territory. So when the slide was being made, we are positive when the Straits Times benchmark is negative, all right? And now we are slowly improving relative to the benchmark again, because banks are taking a beating right now in the stock market, right? So these are real returns that my students have generated through the portfolios they've built over the years. So we don't make money every year. All I'm trying to say is that we're not perfect. There are years where we lose a sizable amount of money. 2022, because we only have some banks, we've lost in a major way to our benchmark, right? But most of the time we win. Most of the time, we tend to outperform the benchmark, right? Okay. So students also get into a Facebook group where we have community events every quarter. You have continued access to me on the Facebook group. You ask a question, I'll be there to answer them. We already have 600 people that have attended my program. They can assist you with any Q&A. There is lifetime access to portfolios built by subsequent batches of students, and there's no monthly membership. So once you sign up for the course, you join the Facebook group, you have lifetime membership. Every time I conduct a course, you will get the PDF that contains all the investment decisions made by the students of the class. All right. So this makes the course fee very reasonable compared to other courses where they might bait you with a cheaper course and then they upsell you into something that might cost $10,000 to $15,000. You will find that my course is a one-time payment, right? So it's a different kind of business model that we apply. All right, and there's no conflict of interest, because obviously with conflict of interest, the trainer teaches students and they leave them on their own. Now, in my model, the trainer teaches a student, the student builds the portfolio, the trainer invests in the portfolio, and we track the portfolio together as a community, right? So if you make a bad decision, I will lose money and I will effectively have earned less from the class. This is something that I've done since the first batch of the program, right? I want to make sure that compared to other of my competitors, I actually invest, I eat my own cooking, right? And my cooking, they are the decisions made by the students, okay? So there's skin in the game, at least $10,000 for my course fees. Okay, but now these days, it might be smaller because my course fees are smaller. Okay, but it also means that our class size is also smaller, right? So you got more personalized kind of attention. Okay, now to be able to benefit from the program, you should either have capital of at least $10,000 or have income of about $3,000 a month. The reason is because you need to invest your own money to basically cover the investment that you put into a class. All right. So you need some capital. You need to have a laptop and a mobile phone, and you need some mathematics. All right. Lower secondary school maths is good enough. Plus, minus, divide. If you have lower secondary school maths, you should be able to benefit from the program. Okay. But I want to emphasize that IT skill is very important because if your students are not very IT savvy, like for example, some of my students don't understand that email can go into a spam folder, right? It will affect your ability to sign up for a website, things like that, right? So if you are listening to me online, it makes more sense. You should be able to meet that requirement. Okay, here's a case study. One of my students, Donna Derriton of batch 9, she made her first dividend in 16 days. When she came for my program, she was in between jobs and I was very worried for her. She paid for the course and I told her better put your money into Netlink Trust so that you will see some cash flow even though you're between jobs. So within 16 days, she got her cash flow. All right. Donna shared with me this wonderful picture, but Donna's a lady on the right, not a lady on the left. Right. Yeah. So Donna's from batch 9. Donna, 1 year later, these are her results, right? So she got her first golden goose 1 year after the results. In fact, recently, I met Donna again for lunch, and Donna was trying to withdraw money from her brokerage account. I was telling her, shouldn't be too difficult to do that. So I showed her how to do it on Interactive Brokers, and yeah, so she was able to like grab her dividends from IB, right? So she's quite happy, more money to spend, right? Okay, I've shown you guys this photo before. All right, so what is the value of your personal freedom, right? If I could get you 20% towards $500,000, the cost would be worth $100,000. But say we value that at 20%, right? The value of the cost easily, right, over 20K per seat. Right, what you see on the right is a sample strategy that would be used to explain to you how we actually come up with some of the results, right? Some of the investment decisions that we made. The important thing about investing is not the answer, right? If you go to a Telegram group and you say, hey, I want some stock tips, people will give you stock tips, right? The thing is, we want to be able to show you this is the investment decision being made. What are the decisions that led to that? The working is more important than the answer, right? So that if something were to go wrong, at least you know, well, what went wrong in the working, right? What assumptions did we think were true, but turn out not to be true, right? So that's important. And we document that for our students. There is a bespoke PDF that contains portfolio statistics of the portfolio built by the class real time. There is also a regime chart, this colorful chart that shows you, are you in buy or sell territory? Okay, to generate that using a Bloomberg terminal requires $2,500 a month for the Bloomberg rental. And you need to teach yourself how to do that on Bloomberg. My program, I've got the web apps to be able to generate this for you. All right, so I'm a programmer. I do a little bit of Python programming, so that makes a huge difference, right, compared to other trainers you might find in the industry. There's a beginner's guide to get you started on at least one trading account. It contains a reading list for you to read so that you will know how to get started in investing. So this is another valuable part of the training. I have a network of partners and tools. These are software developers who are also students of my program, and I work with very closely to develop these tools, right? So Stocks Cafe students get a free 3-month subscription when they sign up for their 3-year plan. Pi Investing is a fundamental backtesting tool that I teach my students how to use. Collectively, these software subscriptions don't exceed $20 a month, right? They don't exceed $20 a month. No expensive software subscriptions, right? When you sign up with me. And finally, once again, the Facebook group. This is a community where we meet together, we discuss, we talk about financial markets, and people generally mingle. They mingle and they talk about things, okay? And we will discuss portfolio decisions. If there are questions on like how to use interactive brokers, they will come here and we will troubleshoot together. 600 people troubleshooting together, right? So the value is timeless because it is lifetime membership. We don't collect money once you pay for the course, right? Okay, so we conduct 4 days of online webinar from the 5th to 8th of September. All right, 5th to 8th of September, 7:30 in the evening to 11 o'clock. All right, but typically we end before 10:30. All right, I manage your expectations. We cover basic finance, how the economy works, how do we invest, and then we talk a little bit about blue chip investing, fixed income investing, small cap growth, and REIT investing. So there's a big chunk on investing. And then we will end by talking about leverage, right? How do we calculate leverage? What is the maths behind it? How do we engage in a leverage account? And then we have to end all this by talking about CPF and SRS, right? These government schemes are important because they also play a major role in your early retirement. We meet face-to-face on a Saturday. On the 9th of September, we will meet. We meet from 9:30 to 5 o'clock, where we conduct a quiz. We revise everything that we've learned on the past 4 days, and we conduct an exercise, right, to basically build our portfolio, right? So Saturday is the most important, where we will actually make investment decisions that will be executed on Monday or Tuesday, right? So I'm summarizing everything that we have here, all right, 3,888. And if you put your information on the form that has been shared by Dr. Wealth, there is a promotional price of $2,568. All right, so you got a better price. If you use a credit card, we can break it down into 12 payments of $200+. So if you can have enough capital to get 2 golden goose, right, the golden goose can pay for itself. All right, yeah. So that's how we make this accessible for younger Singaporeans. Now remember this: if you already have $100,000 worth of capital, if you attend my class, you're very likely to be able to get $5,000 to $6,000 of dividends every year, which means that you will break even maybe in about half a year, right? Okay, come for the first day of the program. If you're not satisfied, you think that this course is not for you, feel free to exit and you can refund all your money back. All right, so we minimize the risk for you when you sign up with us. If you act within the next 72 hours, you will receive 3 of my written books in PDF format, a collection of investment articles for beginners to read prior to the course, and there are 2 bonus lectures. They're a little bit dated, but they're on earning more money, saving more money, right? So these are basics, they're not investment related. So we package them up into the free package and we give them to people who sign up within the next 72 hours. And so our next program, 5th to the 9th of September, $2,568. All right, so now let me just have the Q&A section, right? Some questions might have popped up. All right, I'm going to do my best to answer them. All right. Alvin Lim, what is your age when you restarted law? I was 40 years old when I entered law school. All right, 40 years old when I entered law school. I got admitted to the bar when I was 44 years old. All right, yeah. Miss Sun, what were the 2 books you recommended earlier? Didn't manage to take them down. All right, so let's go there. Yeah. Okay, knock yourself out. The Richest Man in Babylon, The Conceptual Foundations of Investing by the Cornells. Right? Right. So, okay, next question. Sherlyn Tan, if you are in your early 20s, more risk tolerant, how would you allocate your paycheck into the stock markets and REITs respectively? Right, Sherlyn Tan, I'm just speaking for myself, and I know not a lot of people in their 20s will do this, right? I'm sort of insane. In my 30s, I was putting, when I just started, I got my first investment, and it wasn't a very good investment. I put $300 into my unit trust every month on a regular savings plan for the first 6 months of my working life. Then I went crazy. I started to put 50 to 60% of my paycheck into the stock market. You see, I was very lucky. I mingled with engineers from India who are contractors with my company, and they have a different set of values compared to Singaporeans. They tell me that Singaporeans don't know how to save money, and that for them, the bare minimum is 50% of their paycheck. I say, look, if you can do it, I can do it, right? So I started saving about 50% like in my 20s. Before my 20s ended at the age of 30, I was doing about 70 to 80% of my paycheck. I was saving that amount. And it got me into the newspapers because I wrote a book on it. So, and you will get the book, right? It's part of the PDF that I'll send to you if you sign up for my program. And by the time I was 31, 32, I was saving 100% of my paycheck. Yeah. But you need to understand, I'm living with my parents, I'm a bachelor. So I have a lot of freedom to basically accumulate a lot of money during that time. And I spent a lot of time studying the CFA in the data center, doing overtime for the company at the same time, right? So a lot of wealth was made at that period of time, all right? So how would I allocate? Okay, same thing, right? It will be a blue chip and REITs mixture, right? A blue chip and REITs mixture designed to give maybe 5 to 6% dividends every year because I want to see that thing generate money, and I do spend the dividends, right? Because if I'm in my 20s, I do want to watch a movie, I do want to entertain myself, all right? So that happens, all right? Okay, next question. Kawi, all right? A question about the ERM data entry tool. By relying on that, does it mean that as participants, it would be independent to be independent retail investors in case where the tool is no longer maintained for whatever reason? Oh, no. Okay, so Kawi, right? The two tools that you'll be using on your own that I would teach is Pi Investing and Stocks Cafe. These are software as a service offerings from someone else, right? They are developers who also happen to be students of my program. The ERM data entry tool is a specific tool for me to conduct classes. So I will switch on the hosting for my laptop. You go in, you do your data entry. I'll produce the PDF, I'll send it to you. Then the next time I conduct a class, I will switch on the web app at the same time, all right? So that's not available for most retail investors, right? For proper investment planning, making investment decisions, I will teach you Stocks Cafe and Pi Investing, right? And these are the tools that are already being hosted in the cloud, and the hosting fee is very high. Thousands of users, big community, right? Okay, CW Club. What is the dividend paying stock crashes? Yeah, so normally when we are dividends investors, if a stock crash and it continues to pay a dividend, what does it mean? It means that we buy more. It means that we have a massive discount and we get to buy at a discount. So I think that's what the presentation wants to share with you, in that we want to wait for opportunities like that to buy as many dividend-bearing stocks as possible. But of course, we spread our money across many stock counters, and you keep holding, right? In fact, you keep holding is not enough. You keep buying, right? Okay, so that's a short answer. Kawi, what are the assumptions of the tool? Will that be discussed? Yes, right? The assumptions of the tool, I will teach them in the course. We do have some weaknesses in all the tools I have, like survivorship bias, a little bit of data mining. So the weaknesses of the tool are the traditional weaknesses that a data scientist would need to be careful about, all right? Of course, I summarize it and make it easier for the layperson to understand. The second question is about Python programming. Is there an avenue to learn Python programming? You can attend my other preview on a more Python-oriented like kind of training on exchange-traded funds. That's my other all-weather portfolio offering. Okay, you can look at that. But generally, I don't teach programming, right? The reason why I don't teach programming is because there are many people who do it at a cheaper price. Go to Coursera, go to Udemy. You can pick up a course on Python programming very easily. Now, for the people who are serious about Python programming and you're listening to me, there's a very good book called Learning Python the Hard Way. All right. Yeah, for me, I like to learn everything the hard way, right? Like finance means CFA, learning how to draft a contract means actually going to law school. So learn Python the hard way, all right? Yeah, so you can look out for that book, all right? You can check it out from Kinokuniya if you want to learn Python, okay? Yeah, and it's very dry. You learn it the hard way. Yeah. Oh, CW Chua, how do you decide whether to sell or to hold? Okay, most of the time I'll hold, but generally when there's corruption in the management, there's a permanent impairment to the business, we will find a way to sell. All right. Yeah. My course is not very strong when it comes to selling because it is training for you to build a portfolio and holding on to it for dear life. Now, you will lose a little bit of money on some of your dividend stocks, but you also make from the others, and the good and the bad sides will cancel. They'll cancel each other out and give you a decent return at the end of it. All right. So generally, that's how I make a decision on whether to sell and to hold. Generally, I strongly encourage you, right, to hold. Okay. Julie Yi, I'm 57 years old. I only have $50,000 of cash to invest for dividends. Monthly $500 to add on only. What type of REITs or other stocks do you advise? Well, yeah, that's what my course intends to answer. My course will show you how to build a portfolio to invest this $50,000 in a diversified manner. Okay. And then every year, every month, you can accumulate the $500. At the end of the year, you will rebalance and you make your portfolio size bigger. All right. So the specifics on REITs or stocks, right? The recommendations and all that, it's fairly technical. I will cover them in my course. All right. So yeah. Okay. Currently, is it the right time to start buying property REITs? With my limited resources, is it suitable to join your workshop? I think it is suitable to join my workshop, but never ask a trainer that, right? Never ask a barber whether you need another haircut. Of course, the answer is yes. All right, but you got to make the decision on your own, lah. Right? Now, is it the right time to start buying property REITs? I believe it is, right? And the answer is because dividend yields are on the relatively high side, and REITs have suffered because the interest rates have gone up quite a while. If you buy now and interest rates drop in the future, you're likely to benefit from it. All right. So this is a good time to buy, but you will suffer in the short term. All right. If you buy now, you're going to suffer a little bit of red for a year. So do you have holding power? Can you hold for 2 to 3 years? So that's a question you want to ask yourself. All right. Thanks, Chris. What are the merits of doing this versus simply uh, buying the S&P 500? The S&P 500, first of all, the volatility is relatively high. It doesn't produce dividend yields for you. When it produces dividends for you, the US government takes 30% in withholding taxes away from you. So that's the problem, right? And the S&P 500, historically, they've done very well. So the price earnings ratio is very high. So you are going into the S&P at a more expensive price than coming in for these Singapore blue chip stocks. Traditionally, Singapore is a very boring market, right? But it also means that you're going in at a price to earnings ratio of 10 to 11, which is on the cheap side, right? And that is why when there's a market crash like in 2022, you find that Singapore tends to do very well when times are bad. So this is really a defensive strategy, right? If you want to do something very aggressive, then you might consider buying the S&P 500. But my other course deals with how do you improve the odds of doing well and coming up with a series of momentum-based strategies to improve on these strategies. So you might want to come for my other preview if you want to know further on how to tune the performance of S&P. All right, they're totally different things. They're apples and oranges. MS Sun, your portfolio focuses on Singapore shares. Actually, the portfolio focuses on Singapore shares, but I will teach you how to apply this approach to US shares as well. So we do teach international investing, right? It's like this, right? You've got a math equation. It applies to many areas in your life, right? It's just that with Singapore shares, it's easier to teach Singapore students. But when we apply this to another, like the US or a program. All right. So for those who like US stock market, I know a lot of you guys do, you definitely get something out of this class. All right. Okay, I guess we're done with all the Q&A. So what I'm going to do is that I'm going to conclude my presentation. All right. Okay. Now, before I end, I'd just like to talk a little bit about some of the things that you might want to ask broker or financial advisor. I mean, the question you can ask a trainer as well. Where are your customers' yolks? If your trainer is rich and your trainer is a multimillionaire, it doesn't mean anything, right? You need to know how well the students are doing before you decide to go with a particular trainer, right? So with that, I share with you a student of mine, student M. They are part of a couple of high-powered finance executives. They are mid-30s. The husband attended the course in December 2019, so the couple have a very strong foundation in finance. The husband and wife, they put 30,000 into every ERM portfolio until the present, and they leveraged it by 2, which is a very risky kind of behavior. And they leveraged it through the pandemic, all right? So very, very smart, very savvy couple, finance trained, but fully powered by ERM, this early retirement masterclass. So when they showed me their results in 2021, they were making 17%. In 2 years, they've accumulated $1 million, right? 2 years. Half of the portfolio is owned by the couple. The other half is basically money owed to the broker, all right? Because it's a leveraged portfolio. But to build something of this size, a 7-digit portfolio in 2 years after attending one investment course, right? So that's generally the kind of benefit, right, that a good investment program can bring into your lives. So I hope that you'll be willing to reinvent yourself for 2024. Give yourself a chance to pick up some skills in early retirement, dividends investing, and let it change your destiny, right? Let this be your new Singapore dream. I hope to see you in class in September. Have a very good day. Enjoy your weekend. Thank you very much.